Hello and welcome to Simply Tax. If you've been listening to some of the tax headlines swirling in the last 18 or so months, particularly in the world of family offices, which is a related world in and of itself that we'll explore further with guest Jack Thurman later this month, you may have heard people talking a lot about Lender. No, I'm not talking about Lender's Bagels, though one of those does sound pretty good right now, but Lender Management LLC versus Commissioner, the United States Tax Court case decided on December 13, 2017, which dealt with an issue of first impression of whether the lender family office entity was engaged in the trader business of providing investment management services. The trader business determination is an important one in the tax world, as much like everything is better on a lender's bagel, tax deductions are better in a Section 162 trader business. We'll explore why on the podcast today, but this significant decision, which we provided a link to in the show notes of this episode, became even more significant from a tax perspective with the enactment of the Tax Cuts and Jobs Act less than 10 days later. Now, being the tax nerd that I am, you might imagine my excitement when I found out I was speaking immediately before David Autry last December at the Mississippi Tax Institute, who along with Patrick McCann Jr. and John Hackney represented Lender Management LLC before the tax court. David introduced me to John Hackney, who I'm excited to say we'll be hearing from on the podcast today.
I'm a tax controversy lawyer at Chamberlain Hurdlicka. I've been doing this this is my ninth year working at Chamberlain. Before I was at Chamberlain, I worked at the tax court. And before I was a lawyer, I was an accountant for a couple of years. So I've got over a decade kind of in the tax world. More of my background and what I do, I sue the IRS for people. Really, is how I explain it in the short way. But taxpayers, 99% of the time, they're going to go to their CPA if they have a problem with their return. Most times CPAs can get that problem resolved. In the few instances where a CPA can't get it resolved, we either can step in for an audit case that is going to get litigated, or if the CPA can't get it resolved, we'll step in and try to help resolve the case kind of once it needs to go to tax court. So that's what I've done for the last nearly a decade, is just defend taxpayers in front of the IRS.
The question of taxation touches every home in America.
Cutting through the static of the tax world, it's Simply Tax.
Let's start today by learning more about how John and his colleagues got involved before he lends a hand in providing what I think are tremendously helpful insights into this important case.
We got involved in the lender case by referral from the accounting firm that handled the work for them. We filed a petition on behalf of lender management and took the case through the appeals process, which was unfortunately unsuccessful, the administrative appeals process, and then took the case on and tried it before Judge Kerrigan of the United States Tax Court. I was second chair in that case, and my colleague David Autry served as first chair.
Now, I mentioned earlier that this was a significant case, and obviously he's a bit biased, but John would agree.
I mean, it was definitely really an interesting case, and I think the reason it went forward was because there really isn't a case on this very particular issue. There's a host of cases on what's a trader business. And what you'll find kind of if you dig into that issue is there is no one definition. The code uses the term trader business a couple hundred times throughout, and it can mean one thing in one section and something else in a different section. So you may not have the same definition. It's a wide ranging topic, but it's also kind of one of those things that people think, oh, well, this has got to be a trader business. Well, is it really? Let's think through the nuances of why it could be or why it couldn't be. And because the issue of trader business hadn't come up in a reported decision before in the case of a family office, it was a really interesting case. And you had to kind of weave through several Supreme Court cases that were very old pronouncements and trying to weave in a coherent legal narrative that thankfully the court found in our favor.
The determination of whether an activity rises to the level of a Section 162 trader business is inherently a factual question, which means the answer is, well, our favorite, I guess, but least popular, it depends. And it's not an easy one. A related topic that wasn't per se addressed in the lender case, but is one that similarly has received a lot of attention after the 2017 tax overhaul, is whether a rental activity rises to the level of a Section 162 trader business. In fact, with the qualified business income deduction or Section 199 Cap A and the new business interest expense limitation or Section 163J, it's probably the most frequently asked question I've received this year and during the recent tax season. If you're looking for some insight, tips, and takeaways from the more than 100 years of case law on the subject, We released a short video on our new YouTube channel at the same time as this episode to help with this determination, since determining the extent to which the rental of real estate rises to the level of Section 162 trader business can be particularly difficult due to the nature of the business and the inherent investment-like qualities of holding real estate for long-term appreciation. Check it out using the link that we included in the show notes of this episode. Now, as I said earlier, the Section 162 trader business determination got a whole lot more interesting after the Tax Cuts and Jobs Act. I mean, so much so that I went as far as to say that the lender management decision got significantly more interesting. And here's why.
It was very significant in the scheme of things because we were arguing that this was an ordinary and necessary business deduction, which is the Section 162. Section 162 of the code allows for an ordinary and necessary business deduction. So to get the deduction there, the amounts have to be paid or incurred by the taxpayer during the year in question. They have to be ordinary, they have to be necessary, and they have to be, as a final prong, incurred in a trade or business. So that was really the operative question. Is this a trade or business or not? The IRS was arguing that this was a Section 212 expense, or more commonly an investment expense. Essentially, there was a very old case called Higgins by the Supreme Court, and it said, doesn't matter how much money you spend managing your own investments. That's not a business, managing your own investments. Congress came back in and enacted the predecessor to what eventually became Section 212. That code section says that, okay, you can deduct your investment expenses, but it's a preference item. It's not as useful to your general taxpayer as a business deduction. So what was really helpful for us was to really dig into the facts of the case. As you may see from the opinion, we leaned very heavily on the very excellent work that was done by Keith Linder and his CFO, Lana, and they just had an extensive amount of paperwork and background work that they did. And so we were able to really dive into those background facts and present that to the court, just the tremendous amount of records they kept and the tremendous amount of work they were doing on a day-to-day basis, I think really helped us persuade the court that this was, we're not just managing investments. This is a real business.
Did you just catch that? An important aspect and point that is sometimes missed is the good trader business fact pattern in the lender case that is not always common in the family office space. And further, those good facts were all well documented. Again, something that you don't always see. What do you think the outcome would have been if those good facts weren't present and accounted for?
This was just sort of a post office box sitting out there. It would have been a different case and a different holding. But because the work was so significant, and that may not come through in the opinion, I think it certainly came through at trial. Being able to lean on a taxpayer's facts and circumstances helps tremendously to get a court to understand your position.
Okay, so we know we need to be a trader business for expenses to be potentially deductible before the application of the complex loss limitation rules that we discussed in episode 48 with guest James Anderson, and that it depends on your facts and circumstances. But do you know what it actually takes to be considered a Section 162 trader business under the case law? And what are some of the things that you'd want to document?
There's a case from 1986 called Gratzinger that basically sets out a baseline test for what's a trader business. And the court cited it in our case, and we argued it in our case. But it basically says that to be engaged in a trader business, you have to be involved in the activity with continuity, regularity, and with a primary purpose for making a profit. So if you think about the continuity and regularity standpoint, you're trying to show activity, right? You're trying to show, like in our case, that Keith was showing up to work every day, that he worked 50 hours a week. He was taking calls all the time. He was doing cash flow projections. And there's a lot of information that's set forth in the opinion, and you can really see the work that they were doing. Lana, the chief financial officer, was doing a tremendous amount of work from a cash flow perspective. And so kind of from that perspective, you're given that narrative of a day in the life for these people and what it's like, what they're doing. For the profit perspective, you're leaning on a lot of the documents that are kind of set up the structure. You're trying to show from a compensation perspective how they make their money, what drives how they make their money, and did they actually make a profit? In a couple of the years, I think they actually had incurred a profit when you considered all the sources of income coming into the partnership.
So I guess basically, once again, much like how everything's better on a lender's bagel,
a case is better and an argument's better just with all that extra information to show, we're running this as a business, but we're not running it as a business because it is a business, and we're doing the things that a normal business would do. Keeping books and records, filing all the necessary returns, doing all the paperwork, keeping track of things. That was incredibly helpful.
By now you might be thinking, Wait a minute. I know more about what it takes and what to document within the purview of Section 162. But what about the exception for managing your own affairs if you're a family member managing the investment for the family's family office?
And that's a great point. So that Higgins case is sort of the one the government brings up in these issues. And the guy was essentially managing a massive portfolio of money, I think like $20 million, which was a huge amount of money in the 30s. And he had an office in Paris and an office in New York. And the court said, basically, it doesn't matter how much money you spend, or you're still managing your own money, and that's not a business. What the important thing we were able to show here is that Keith was managing money for other people. In lender management, a diagram is a really helpful part of kind of the whole case. But if you go in and try to diagram out the entities, you had lender management on one side, and it owned a profits interest in a series of investment partnerships. And those investment partnerships were owned by sort of the greater extended lender family. Well, Keith was a 99% owner of lender management. And so essentially, if you look at the overall portfolio, he owned a very small slice of the overall portfolio that he was managing, and the majority of it was owned by other people. So, and a very important point there is that he's managing money for others. And if he's managing money solely for himself, you're kind of back into a Higgins concept where you're not. It was very important, I think, to the court's decision-making that Keith was, in fact, managing money for others. So we went through kind of how much Keith actually owned of the overall portfolio. We went through in the court notes how much his father, who was the managing member in one of the years, owned of the actual portfolio. And because this was a pass-through entity, that is a big deal. I think generally in these family offices, you're looking at a tighter group, but in lender, it was a more extended group. And I think we made that point, and the court appreciated the point that no, lender management's managing money for others that may be related by family relationships, but it ended up being for other people. There's a section in the opinion about the family relationship, and we talked about how the other family members knew that they could essentially fire lender management if they wanted to. There was an understanding among them, and the documents provided that if you wanted out, if you were unhappy with the services, you could take your money and go. And that's important because, one, it shows you that I'm working for other people, and two, I've got to do a good job if I'm running the family office. And Keith obviously did a tremendous job here, but he's got to do a good job managing the money. Otherwise, he could be fired. I think that was an important aspect of the opinion, and an important part of the holding is this kind of managing for others concept.
All right, so let's check in here. You've got to be involved in an activity with continuity and regularity. Your primary purpose in the activity must be for income or profit, and management of your own investment portfolio is not a business, regardless of the number of hours that you spend. But there's one more big and important element in lender that led to the very favorable tax result that many have been buzzing about.
Lender management got compensated through a profits interest. They got essentially, I think it was 2.5% and 25% during maybe some of the years in question. There's an older tax court case called Douglas versus Commissioner. And in Douglas, that's a business bad debt case. In other words, in a business bad debt, I can deduct the debt in the year in question. If it's a non-business bad debt, in other words, if I'm not in the business of lending money, or I didn't lend money part of my day-to-day operations, it's a short-term capital loss, which unless you have capital gains is limited to $3,000 a year. So the court in Douglas was trying to figure out, is this part of the normal business? There, the person ran a venture capital fund, and the court made the point, which we relied on here and is cited in the lender case, that the taxpayer is getting paid the typical what you see in a hedge fund context of 2 and 20. Well, the compensation is not the 2, it's the 20, right? The 20% of the profits is what's motivating that taxpayer. And there's no reason that a taxpayer would pay that 20% but for somebody else's management skills. And so the court makes the point there is that essentially you can be in the business of selling your investment services like a JP Morgan or a Merrill Lynch or a Morgan Stanley. And that's a trader business. And here, the compensation helps show that you're in the business of providing investment management services to other people. So that profits interest, that 2.5% and 25%, is the motivating point.
There's a fundamental economic difference here for Keith Lender in this case, as the one operating the trader business of providing investment management services, and one that is often, in my experience, a sticking point in setting up this type of structure.
The profits interest piece is definitely a key element of the structure. It is, I think, probably one of the hardest pieces of the structure is figuring out the profits interest, because you've got to be able to calculate it and figure it out and make sure that you're covering costs. And there's plenty of ways that it's it's one of the harder kind of aspects of the case and of any planning that I think that goes into this structure. There's bigger partnership issues that are out there related to the profits interest structure, which are kind of beyond our discussion here today. But there's new profits interest regulations. How is it classified for tax purposes that are sort of beyond the scope of what we're talking about here? But it's a huge part of the structure and a huge part of the planning in this area. Because if you think about it, I'm taking a risk as a business owner by providing these services, and I have to, and that compensation is not guaranteed. It's a risky proposition. I've got to perform, for a couple of reasons. We talked earlier about the fact that you could get fired. So if you underperform, you could be out. And if you adequately perform, you may not cover your costs. So there's definitely risk involved, and it's definitely an incentive. And I think an incentive that the court found very helpful in Digress and in our case. But that incentive compensation structure, I think, is very relevant and very big piece of this.
Another non-tax hurdle that comes to mind when discussing this case is the possible registration requirements under securities laws, since we overcame the argument that Lender Management LLC was managing the investments of the lender family because it manages investments for each of its clients individually. So, does this subject the LLC to registration requirements?
That's an interesting question. And so just to be fair, I'm not a securities lawyer, but it did come up in our case. There is an exception. I think I can't recall if it's the Dodd-Frank or it's the RIA rules, Registered Investment Advisor rules, that basically says that a family office that manages only for a family, it doesn't have to register. Because this was a family office that managed family money, I think they fell within the exception. But you really do want to be intentional about your planning in this area. You're planning for securities purposes to make sure that you're not running afoul of any securities problems, because it's definitely something that needs to be considered. I mean, I'm not a securities lawyer, but I'm assuming that there's probably fines and problems and trouble you could get into if you get beyond the family office exception.
As you've probably already deduced, the lender management case is complex and there's a lot to unpack in it. I think John has done a great job of helping us gain an understanding of the key technical issues so far. So now that we're about 18 or so months in on both the lender decision and the Tax Cuts and Jobs Act, let's turn our attention to what John is seeing and hearing after the case.
Some of the guys that we worked with on this case mentioned that kind of if you've seen one family office, the joke is that you've seen one family office, and family offices really can get structured in a variety of different ways. The change, obviously, with the Tax Cut and Jobs Act making Section 212 expenses no longer deductible, I think lender can offer a roadmap of one way to structure your family office so that you can deduct those expenses. It definitely presents a planning opportunity. I don't think it's a simple planning opportunity, and I think it's definitely one that you want to get very good advice and very good guidance on trying to do the planning around. But it is a way for families to organize themselves that potentially and then be able to deduct the cost of operating a family office. The bottom line, with the changes to the tax code beginning in 2018, that's probably its most significant authority. Prior to the change in 2018, you could deduct the expenses as investment expenses, but it didn't have the same bang for his buck as a business expense. But now with the change to 212 and the miscellaneous itemized, it's a much bigger issue for families that have these family offices that are incurring these expenses. I think it's something that people are definitely taking a hard look at, especially now that everybody's is filing or has filed those first 18 returns.
If you listen to Simply Tax through the build-up and enactment of the Tax Cuts and Jobs Act in late 2017, you'll know that I'm not only a big enough tax nerd that I messaged many of my tax friends in excitement when I was sitting through that presentation that I mentioned in the introduction to this episode that John's colleague David Autry gave on the lender case, but I also had some Friday night tax bill parties with my then 3-year-old twins. I mean, I know, right? I sound like a pretty interesting guy to meet at a cocktail party. Let's hear now what the enactment of the TCJA was like 9 days after the decision to lender for John.
It was definitely interesting because I think, the case came out in like mid-December, and at like the end of December is when the Tax Cut and Job Act went through, and you're suddenly like, oh, this is a great win. And then you're suddenly like, wow, this could be a fairly far-reaching case with this change in the law. So this has been an interesting case, and it's the interest in it is going up because of the change in the law for families with these kind of family offices. But that change in the law was a pretty interesting to see happen. It was kind of boom, boom, or at least in the tax world, it was boom, boom. So
A common question I get from advisors, families, family offices, and, well, pretty much anyone that's interested in the decision is, are many families and family offices organizing or restructuring with the case in mind? Here's John's take.
I think there's definitely a lot of interest. I don't do a ton of planning. I do kind of more in the controversy area. We have a great group of folks, and I think they're busy looking at this for different people. I think this is definitely something you want to make sure, from a planning perspective, you're very intentional about. I don't necessarily think that implementing a lender style structure is going to be a simple process. I think it's going to take some real thought. I think there's costs involved in trying to figure out if it works, trying to figure out the size of family that it works for and the net worth. And it's obviously that adds some administrative headaches and things of that nature. And so there's a question on, trade-offs and who it helps and who it doesn't help and that kind of thing. But I definitely think that because of, the change in the law and now everybody's writing those checks and really kind of the rubber meets the road with these expenses, that people are definitely looking into this area of the law.
So as John told us today, implementing a quote-unquote lender management structure can be a significant paradigm shift for a family office that isn't a plug-and-play type of solution. Remember, you have to stress test the structure, and it's pretty important that those who are doing the work keep in mind that they can get fired for not doing the work. Here are some closing thoughts from John on approaching lender management-related planning strategies.
This is not a simple fix. I think it requires some real strategic thought and some looking at this from, partnership tax perspective, from an income tax perspective, from an administrative burden and record keeping and the other kind of things. So you're really, you're not letting the tax tail wag the dog here, that you're really thinking through, all right, I'm really ready to reorganize my entire family office. Is this going to be truly worth it for me? So I think that's kind of one of the more important aspects of when you're going through this. And I think then once you do it, I think the most important thing is to make sure that you're acting as close to, a JP Morgan or a Merrill Lynch as you could. These family members are now your clients. Are you meeting your clients' needs? Are you responding and doing everything? But I think so you want to make sure that you're putting forth that effort day-to-day basis. One of the issues we focused on in our case was just the sheer amount of work that Keith and the CFO Lana were doing. And so it's not set it up and forget it. It's work. And so I think when it comes to the structuring standpoint is, do we have somebody that's going to be able to devote the time? Are they qualified? Can they get qualified? It requires a lot of thought. It requires a lot of structure. So I think having people, like yourself or others that are going to put forth that real intentional time is going to be incredibly important when it comes to trying to structure one of these things. Anybody that's interested, I'd read the opinion. It'll give you sort of a glimpse of kind of the issues. We're touching on them, briefly here, but it's, I'd read the opinion. I'd go over it with your tax advisor, and I think you can kind of really try to dive into to whether this works and whether this is appropriate planning opportunity, and try to get some good guidance out there and see if this is a fit.
I think I also kind of take away that I'm getting here too is, is the dynamic between, yourself and the kind of legal team and the tax advisor. You'll probably bring the investment advisor and the investor, that group, whoever's actually going to be doing this work, Keith Lender in this case, into the mix and having everybody at the table to do the meeting and have the conversation after reading that opinion and digging in, because it is there's a multidisciplinary exercise here, I think, and doing it in a vacuum is probably a dangerous thing. So I appreciate your perspective.
Yeah, no, I think that's an excellent point. You really do want to get everybody involved and make sure you do it in a privileged way, but definitely get everybody involved.
Certainly. I would say, as I was thinking, I'm like, but probably, I don't know if I got my order in there right, but want to make sure that right, we get the counsel in there first, right?
I want to know what you're seeing and hearing about the lender management decision. Let us know in an email to simplytax@bkd.com. Or better yet, let me know out on social media. You can find me out on Twitter, where I tweet about tax at Damien Martin CPA, on Instagram, where I post about my life at the intersection of tax and being a dad at TaxDad, on YouTube, where we're now starting to share video content to help strengthen your tax mind, and out on LinkedIn. And speaking of YouTube, don't forget to check out my short video on rental activities as trader businesses. I'd like to once again thank John Hackney for sharing his insights on the lender case, for David Autry for introducing John and I, and for tolerating a few punny tax references along the way. Until next time, I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.